You'd be surprised to know that in just the beginning of 2025, Indians borrowed 15 lakh crore worth of loans, expanding country's total loan book to 175 lakh crore. And this is only from banks. I haven't even counted NBFCs, instant personal loan apps, or P2P platforms yet. On a platform like LenDenClub alone, over 3 crore users participate and more than 17,000 crore has already been lent. Credit in India has become so accessible that most individuals today carry at least one or two active debts at any given time. Among the many credit models that exist, P2P lending stands out as a two-sided benefit system, an earning avenue for those who wish to lend their surplus, and a fast, seamless source of credit for those who need it. But have you ever wondered what was the gap that led to the evolution of modern credit? And how did P2P lending begin in the first place? Welcome to episode 1 of P2P Lending Playbook. Stay with us because by the end of this episode, you will understand how the credit gap, both then and now, has shaped new opportunities for people to lend, earn, and diversify alongside their other financial avenues. Lending and borrowing have been prevalent for quite a long time. See, in 600 BC itself, people relied on the barter system, that is, goods exchanged for goods, simple and trust based. Then around 200 CE, India began using early coins and commodity money, small informal lending practices. And then slowly, written loan agreements came into the picture. They started getting tighter with merchant lenders and community finance. In the 18th century, organized banking began taking shape. See, each era built on the one before it. In the early 2000s, we can also call it the pre-digital era, processes were physical, documentation heavy, and built for traditional professions and businesses. For many people, this system worked. But as India's population grew and new professions emerged, the definition of a typical borrower expanded beyond anything the older framework was built for. There were more new professions that came into existence with the rise of the internet, like freelancers, gig workers, micro entrepreneurs, online sellers. This crowd needed credit, but lacked long financial histories, not because they were risky, but because documentation norms had not caught up with the new ways of earning. So when they applied for credit, they often encountered loan rejection, all of which added even more to the credit gap that was slowly widening. Informal lending also played a major role during this time. People borrowed within closed circles using promissory notes under the Negotiable Instruments Act of 1881. And many relied on local money lenders when formal options were not accessible. At the same time, a new kind of participant was emerging in the credit ecosystem. Young professionals with better salaries and income, stronger digital finance habits, and growing awareness about building regular earnings. They wanted to put their surplus money into an earning avenue, one that did not require long lock ins and offered better, more consistent ROI style outcomes. And this is exactly where P2P lending stepped in. It created a digital marketplace that connected MSMEs and individuals needing instant, smaller ticket funds with verified lenders who had excess money and wanted to earn without being tied up to long periods. A system where both sides could benefit, efficient access for borrowers and meaningful earning opportunity for lenders. That's how LenDenClub was founded. But guess what? In countries like UK and US and China, P2P lending had already began way back in 2005. India was late to the party, but for good. Zopa was the world's first online P2P lending platform. A simple idea, but revolutionary. A platform for people who want to lend and people who want to borrow. It took off instantly because it served a need which was never fully sought: fast, flexible, clean access to credit. Soon after, multiple platforms from different countries came into the picture. Prosper in the US, Lufax in China. But here's where the story flipped. The rapid global growth came with rapid risk. As more borrowers came in, as underwriting weakened, as platforms chased scale over caution, the number of loan defaults surged, resulting in the loss of lenders and the trust of the platforms as well. India entered late, but that saved us. When P2P picked up momentum around 2016 in India, RBI didn't wait for chaos. RBI classified platforms as NBFC P2P, mandated full KYC plus income verification. Escrow accounts, so P2P lending platforms never touches the money. Borrower and lender exposure limits, transparent risk disclosures, and more. Just as P2P is regulated by the RBI in India, in UK it is regulated by Financial Conduct Authority. In the US it is regulated by Security and Exchange Commission, the Consumer Financial Protection Bureau, and the Federal Trade Commission. Which means P2P lending is no longer an experimental concept. It is now a globally recognized regulated financial model. So, yes, it is better to say P2P lending is a structured, regulated, and opportunity led earning avenue that helps bridge India's credit gap responsibly. It combines credit access for borrowers, disciplined earnings for lenders, and a regulatory foundation that ensures sustainability. What began as a workaround to traditional systems has now become a credible RBI regulated financial ecosystem.